There's a single valuation metric few people use, but it's allowed me to smash the S&P 500 with all 7 investments I've made this year. Thing is, I'm a long-term investor really, so I don't expect instant returns, but when you use this metric, your odds of getting them just dramatically increase. Let me show you with real data. This is mind-blowing. You won't see this anywhere else. If you go back to the first trading day of the year, 2nd of January, and split the USA's top 100 stocks by just this single valuation metric into undervalued, fairly valued, expensive and overvalued, we see that on average, the undervalued stocks have returned 24.6% in under 8 months. The fairly valued stocks are 13% and the expensive and overvalued stocks are 2.7 and 8.7%. But 100 stocks isn't a huge sample, so I also did the top 500. It's the same story. In fact, it becomes even more linear with both the expensive and overvalued stocks underperforming the market. Pretty exciting stuff, right? Well, let me tell you the metric. And give me just 3.5 minutes of your time and you'll know how to use it like an absolute pro. Investing is just about finding great businesses at a fair to low price. The problem is, great businesses often look highly valued, especially when you're comparing them against crappy businesses which are deservedly lowly valued because they're crappy. The solution is to value good businesses as the high growth assets they are. And the price earnings to growth ratio is the perfect valuation metric to do that. Here's the magic. It takes the current price to earnings and then divides that by the annual earnings growth rate. Vitally, I use the expected long-term earnings growth rate, which is estimated by financial market analysts, typically for 3 to 5 year periods. If the PEG is below 1, then it's undervalued. If the company simply hits its expected earnings targets, then the share price should correct upwards. Between 1 and 2 is fairly valued, 2 and 3 is expensive, and above 3 is generally considered overvalued. It's those bandings which return these results I showed you at the start. Super simple and super effective, but that's like the entry level knowledge for this metric. If you want to move to the level above the average investor, you need to understand how to calculate this ratio and how to leverage its power properly. For example, take Microsoft's current PE ratio of 39.7, divide it by the expected annual earnings growth rate of 14.9%, and you get the PEG ratio of 2.66. Easy, right? But there's an issue, because sometimes earnings can be inflated by one-off events. When I bought Uber in January, it had a PEG of 0.8, so it was undervalued. By February, Uber was up 20% after their annual report, but suddenly their expected earnings growth rate became negative, which resulted in a negative or blank PEG ratio. Some people would have thought it's time to take that 20% gain and run, but no. Because Uber's earnings included a huge one-off tax benefit, making up to 65% of the profits. These tax benefits happen a lot, by the way, and it means you have to recalculate the PEG yourself. Remove that anomaly, and Uber's PE ratio went from a misleading 17.4 to around 50. Seemingly expensive, but now its PEG was a fairly valued 1.6. I bought it undervalued, enjoyed the 20% correction, and now it was time to just enjoy the benefits of owning a great, fairly valued business. Meanwhile, 90% of investors missed it because they didn't know how to calculate the PEG ratio. Now you do. But there's one more awesome thing you can do with this metric, which very few people do. Earnings estimates are notoriously unreliable, which presents a risk because half of our calculation is based on the earnings estimates. But if you calculate the PEG yourself, you can use it to your advantage to evaluate that risk. Let's take Nvidia as an example. Right now, it trades at a PE of 55.96, with an expected 5-year annual earnings growth of 30.97%, giving it a PEG ratio of 1.81. It's still in the fairly valued category just, but it's almost hitting expensive. So, with this information, we can figure out how much Nvidia would have to underperform those estimates in order to be considered expensive or even overvalued. If the growth drops to just 27.98%, then that PEG becomes 2. And it would have to drop right down to 18.65% for Nvidia to be overvalued. Now let's take Palantir. For their current massive PEG ratio of 20 to come down to a more reasonable 2, their expected earnings growth of 33% per year would have to be more like 338%. A pretty tall order and certainly not a low-risk investment. Can you see just how much information you can get from one metric once you understand how to use it? Pretty cool. But first you need to know how to actually spot a good business. So watch this video here where I show you exactly what drives long-term share price growth.